Hey guys, welcome to a new episode, and today we'll be going over my TFSA portfolio as well as two pieces of news that I found very interesting recently relating to stocks in my portfolio. The first piece of news relates to Air Canada, as the stock has crashed from the mid-20s all the way down to the mid-teens. So we're seeing about like a 30 to 40% discount on the stock right now. And the second thing we're going to talk about is what stocks do well in a recession or during high inflation. And is now the right time to purchase these stocks? So first, let's talk about Air Canada. This is a stock that I've been snatching up as it's been in the mid to low 20s, and the reason is I believe that the pandemic is pretty much over and we're going to return to normal air travel. And for that reason, I anticipated that Air Canada stock would soar over this summer because everyone wants to travel, including myself. However, that has proved to be wrong so far. The first big piece of news that has sent shudders down airline investors is the fact that Air Canada announced they're reducing their flight schedules over the summer. And the summer is the busiest month for air travel. So why is Air Canada cutting their flights, especially when peak demand is coming back right now? They report to have about 90% of the demand that they had in 2019. Well, the main reason is Air Canada can't keep up with their staffing. If we look at the stat on the screen right here, they had about 32,000 employees in 2019, and as of 2021, they had about 20,000 employees. So they cut about maybe 12,000 or 13,000 employees throughout COVID. Now, the problem with cutting that many employees and all of a sudden wanting to return to almost 2019 levels is that they have to rehire about 12,000 employees, retrain them all, and get them back in the workforce. When the government finally announced in late winter or early spring that restrictions were going to ease. So the airlines were scrambling to get more employees, but when you work a new job, you don't actually become super efficient until at least 1 or 2 years in. So with the flood of new employees on the scene, everyone's trying to figure out what's going on, and there's a lot of confusion there. And we see it all over the news. There's mountains of baggages just left by the carousel because somehow logistics screwed it up. And that's mainly because there's a lot of new hires not really knowing what they're doing. I'm sure a lot of the people who got laid off from these airlines ended up finding jobs in other sectors or maybe even retired. So I'd probably estimate maybe half the returning employees have previous experience, but then again, they still got to relearn the job, and maybe it's with a different airline. So right now, there's a lot of things at play for airlines where they're not able to keep up with the demand because of staffing. So is this all doom and gloom for Air Canada and the rest of the airlines have got it all figured out? Well, no. I think that Air Canada is at least being upfront with their customers, telling them that they're not able to fulfill the demand that they're seeing in this travel season. So I do think that it's smart of Air Canada to be upfront and honest about this and to tell their customers in advance. But now as for Air Canada stock, yes, it is tanked, and also other airline stocks have been tanked with it as well. Now for Air Canada, I think the best scenario right here is that in 2023 we could see the stock recover. However, I think there's a lot more short-term turbulence in store for Air Canada. So that's why I'm going to continue to dollar cost average into Air Canada over the summer and maybe into the fall or winter. Now for the second item that we're going to talk about today, which is inflation and where to put your money, or what are the best stocks during a high inflation period and possible dangers of a recession. Well, consumer defensive stocks are the place to be because this is where we're going to see the momentum swing for these stocks. Consumer defensive stocks are companies that produce goods and services that people need or deem as a necessity for living their everyday life. The types of businesses we're talking about here are beverage companies, anything in the grocery space, as well as dollar stores. While it's pretty obvious why people need grocery stores, it's because everyone needs food to eat. And when people are going through a recession and money is tighter, people tend to cook in because it's a lot cheaper than going to buy your meals out. So grocery stores might even benefit from an influx of customers who are not eating out anymore and rather cooking their own meals. And dollar stores are also the same thing. There's a lot of basic things that you need that you can get at Bed Bath & Beyond or these more higher end stores like the Bay. However, you can get equivalent products at the dollar store which are a little flimsier but do serve your general purposes. So during these inflationary times and risk of recession, people are going to probably spend more money at dollar stores buying cheaper goods to be able to save every penny that they can. And a lot of the fund managers out there know this, and that's why they're starting to pile into these stocks. And if you look over the past 3 months, these are the types of stocks that generally stay steady or even are on the incline. versus all the other stocks in the stock market have seen a 20 or even 30% decrease, or even more than that if you're in technology stocks. But just like in the beginning of the pandemic, when technology stocks started to soar, is this the right time to buy these consumer defensive stocks? Have we already missed the boat, or is there much more for these stocks to run? If I were to take my best guess, is now the time to buy? It really depends on what type of investor you are. If you're a short-term investor, I would say now's the time to buy these consumer defensive stocks. And that's because fund managers are slowly piling into these stocks because those managers are restricted to only investing in stocks. So as an individual and savvy investor, if you're a short-term trader, then you would probably consider looking into these stocks and buying them for the short term, as these larger fund managers slowly move their assets, billions of dollars, all over to the consumer defensive sector, which is going to do well if we continue to have fears of recession and high inflation. But as a long-term investor, you probably have missed the boat here. Generally, these consumer defensive stocks don't do well during periods of growth in the stock market where we have a bull market. However, in the bear market, they do well. But as a long-term investor, you don't really care about these swings. You're looking for overall growth. Yes, these consumer defensive stocks will have overall growth in the long term, but it's not as great as other sectors of the economy. Generally, these stocks are slower moving and it's a fairly saturated market. But there are some exceptions. For example, Dollarama has been a really good stock over the past 5 to 10 years, and it looks almost like a growth stock. And that's because the dollar store market in Canada was not saturated, and Dollarama became the #1 player in Canada and continues to grow their footprint all over the country. But if you're talking about the grocery space, this space is pretty much saturated, and the only way this market grows is if the population grows. Right now, you've got established companies like Loblaws, you've got Empire as well as Metro. So these are some of the big players in the market already. But there aren't really any great growth vectors for these stocks. So these are very stable companies that will continue to pay a dividend and likely not go under because everyone needs their products. Before jumping over to my portfolio, we've got a word from today's sponsor, Neo. About a month ago, I signed up for Neo on the credit card, and finally it has arrived. When opening the letter, these two pieces of information were inside of it. Basically a card telling you, welcome to Neo, and here's a credit card, and it opens up like that. Some of the best perks about the Neo credit card is that there's no monthly fees or annual fees. And on the Neo app, you can see all the different stores that you can get cash back from. And from what I've seen so far, the cashback percentage has continued to change throughout using the card. It changes maybe on average once a month. Occasionally you can find a really good deal where you have a local restaurant giving you 10% cash back. And for me right now, that restaurant is Kismet. There are also other online stores that offer a higher percentage of cash back, ranging from around 5 to 8% from what I've seen so far. However, these are obviously subject to change depending on the partnerships that Neo makes. For a lot of your basic needs like gas as well as groceries, you're looking at 1 to 2% on average. They also have a guarantee for your credit card that you'll receive no less than 1% cash back on all your purchases. So if your total cash back versus the amount that you spent is less than 1%, they'll top that up. If you're interested in joining today, the link is in the description down below and you'll receive $50 for signing up. So here's a spreadsheet where I keep track of everything. However, currently there's some weird errors with Google Finance and just the formulas. So that's why none of my stocks are shown as a dividend stock. Currently, the total market value of my portfolio is just shy of $12,000. I'm at $11,677 and currently down by about 25%, which is a pretty big ouch. Well, the reason why I'm down so much is because I've been dollar cost averaging since last March. So I didn't buy all my stocks last March, but I've been buying every single week. So I've been buying all the way up to the peak that we saw in this past winter, and also buying as stocks have been continuing to drop recently. So I would say I've been buying in the high times. However, right now we're supposedly in the low times. So you could say I'm getting a lot of the stocks that I loved a year ago for a steal of a price. Another number to note is I've collected almost $200 in dividends, and that's not super impressive to most people, especially this is over more than a year. However, I'm building up that amount of dividends that I'm collecting every single month, and we actually did collect a couple dividends just this past week. Going down to my transactions, last two entries here were 2 dividends. I earned $1.09 from A&W, as well as $11.04 from Sun Life Financial. The A&W fund always pays dividends every single month, so I expect from here on out I'll receive at least $1 per month, and I'm continuing to buy more A&W shares, so next month we might be at about $1.50 or $2 per month. If we look at my portfolio, the stocks are right now organized from the percentage return, with the highest loss at the top and the highest gain at the bottom. You can see the risk level though of all the stocks that have the highest losses. They're in the medium and high category. And all my low risk stocks are somewhere in between. You can see right here, most of the stocks that are doing the best are low risk and medium risk stocks, with Dollarama being the shining star in my portfolio right now, up by about 32%. So as I was talking about earlier, dollar stores are one of those consumer defensive stocks that will do well during a recession. Another stock that will do well is telecom, because people can't live without their cell phones. So in a recession, generally people will still keep their plans because they're locked into those plans. So the income for these companies like TELUS and Rogers and Bell, it's going to be pretty stable during a recession. And by stable, I don't mean like they're not going to see a drop. They probably will see a slight drop in the revenue as well as a slight drop in the profitability. However, they're not going to see these major drops at other businesses that are more in the lifestyle category, which we'll see. For example, a lot of the clothing stores, they're going to get hit harder because people don't need another shirt or another pair of shoes. They already have a lot in their closet. So currently, what is my focus in this portfolio? And what stocks am I trying to allocate more funds to? Well, going to my transactions, you can see the types of companies that I'm buying. In all these companies that I bought this past week, they do pay a dividend. Power Corp of Canada currently pays about a 5 to almost 6% dividend. Enghouse is a bit more on the higher risk side as this is a tech stock. However, they do pay a solid dividend of about 2%. A&W, they currently pay roughly around a 5% dividend. In RioCan, this is a stock that's also dropping and it's paying around a 5% dividend. So right now, as these stocks are falling, I think they're going to recover eventually in the next couple of years. And the dividend payout that I'm getting is around 5% on average for the stocks that I bought this past week. And personally, my target for retirement one day is to earn about 4% on my entire portfolio. So right now, this recession is kind of good news to me. It's that I can buy these stocks cheaper and eventually ride them out into the sunset when the economy recovers. On top of that, not to mention, these companies will all continue to increase their dividends, assuming that they become larger and more profitable. Obviously, it's not a guarantee, but that's my assumption going forwards. And with that, in investing, you have to have a little bit of faith in these companies for them to grow. You don't have total control. In fact, as an investor, you don't really have any control at all. So that's why I also diversify. If you are only invested in 5 or 6 stocks and one of those companies goes down or tanks really hard, that's about 20% of your portfolio. However, in this portfolio, I hold about 23 different positions. So if one position goes bust, that's about 5% of my portfolio. So guys, in rocky times like this is the best time to be dollar cost averaging as well as diversifying your risk over multiple companies or even just in ETFs. If you guys have any suggestions of what companies you want me to analyze next or any pieces of news you'd like me to go over, let me know in the comments down below and I'll be sure to address those in future videos. I've got a couple videos up on the screen you can check out. If you're interested in those, I'll see you there. If not, keep up the grind and have a great day.